Hey guys, what's up? Stock Retail coming back to you. Got a couple things I'm going to cover today. Had a lot of topics I would love to hit, but just not quite enough time to get all of those sort of pen to paper, if you will. So I'll do a few more videos probably after Christmas, kind of on this break, and hopefully hit a few topics, unless I can find some time in the next day or two. But today, what I really wanted to cover with a little more urgency, because it's kind of bugging me and it's probably bugging you. Perhaps you've kind of seen this I don't know, ongoing discussion about dilution versus value creation, things that if you've watched me for a while, you've seen me discuss before. And in particular, I saw some trolls. They always do this, right? They come out of the woodwork when things look a little more negative for us. So the price action the last few days has not been so fun. And so then they like to just come out and say, see, I told you, haha. But the thing is, the voices that are coming out and doing that are so misleading, and either so ill-informed or intentionally providing their own misinformation that I've just sort of had it. And I'm going to show you the math on why they're wrong, and what kind of value creation was actually, served through this dilution. The actual effects of what Adam accomplished with this, and why that's in many ways good for us. And I'm just going to make that about math, not opinion. So we're just going to look at that. So I understand that sometimes the math videos are not as exciting, don't get as many clicks, but that's all right. If you're here to kind of understand what the heck is happening with my investment and what can I expect in the future, then this is worth it for you. If you're just here for entertainment, then I don't know. Perhaps wait for the next one. But I will say, kind of as a tease for the end of the video, I am going to cover some sort of non-math discussions, a lot going on around Bitcoin and AMC and the SPY ripping and markets and all of that. So I'll kind of give you a few breadcrumbs of where I think we're going, what's next, and through all of this, continue to hear, I have not changed my thesis. I have not changed my point of view. If anything, it's been getting more confirmed lately. So let's go through that. So the first thing is, I saw some trolls trying to hit you with this notion of, oh, dilution's like this slice of the pie, which I found kind of funny because it's actually almost a year ago to the day that I posted a video walking you through the concept of dilution versus the concept of value creation. So if you really want to deep dive on dilution and how business managers create value for their companies and for their shareholders, go back a year ago and go ahead and look at that video. So it just was interesting to me to see the trolls kind of using language that I had used in the past, but attempting to use it against you. So I want to just hammer a couple points home, just real simple ideas. So when you own a share, that is basically like a slice of the pie, right? Like think of a company's market cap as the overall pie. And by the way, that's an important concept to get. You'll see some people sometimes post things like, hey, how come our share price is below, I don't know, I'll make this up, somebody like Cinemark. Or you compare to just any other company. And share price, it's a useful, a useful metric to look at because, of course, day to day we understand price up, price down. But it doesn't tell the whole story. The actual value of a company according to the overall market is what you call the market cap, which is kind of like this pie. It's take that share price times how many shares there are. And not all companies have the same amount of shares. So that's why it's hard to compare share price of company A to share price of company B. People look at something called the market cap. So that's this whole pie, and you own a little slice of it. Hopefully, for some of us, you might even own a lot of slices. And so there's this idea of, well, dilution basically takes the pie and does this picture on the right, where it slices it up into more pieces. And so people try to sort of fear monger against you and say, you're going to own less of the company because your piece is a thinner piece. It got cut up into more pieces. But the point is, what happens if the pie itself becomes bigger? What happens if the market cap, the value of the company ought to go up? And so I'm going to give you a real simple example here. Then we're going to go through and say, what should have happened to our shares since that last earnings call when dilution was announced? We're going to actually go through the hard math on that. But so let's say you had, 1/8 of a piece of a pie, and that pie was worth $16. Again, you can go deep dive on all this from a video a year ago if you like, where I go through a lot more and kind of how this all works and how managers think. So you would have this $2 share, right? Each piece would be worth $2. And now this pie gets sliced into 16 pieces and you're like, oh, crud, I only have 1/16. But what if the pie was now worth $40? A manager did something that provided future cash flows, provided value, perhaps paid off debt, saved interest, added to earnings. These are all things that add value to a company, and that value should be reflected in the shares. This idea of market cap, like I said, is the overall value of a company, and not just its value today, but the value of future earnings. So we're going to talk a little bit about that. I've told you for a while we're going to start talking about the sort of the net present value of money or the time value of money. We're going to hit that topic a little bit today. So I'll kind of start planting that seed more, and someday perhaps I'll do a deeper dive on that as well. But anyway, let's say some manager did a good job, added value to the company, and now the pie is actually worth $40. So yeah, your share, your slice is thinner, but it's still overall bigger. That 1/16th piece would actually be worth $2.50. So even though you have a thinner slice, it's actually worth more than it used to be. Okay, so just kind of have this concept of dilution doesn't have to be bad. If it adds value, if a manager makes smart decisions, then your shares should go up. And so the reason I'm using that word should too is we need to start evaluating, not start, let's be real. I've been here for 3 years. Most of you have been here for quite a while. We have been on a journey of learning what the market is doing and when the market is sort of manipulative and fraudulent against certain companies, right? So we've always learned that. But I'm using that word should because we need to evaluate what the math says the shares should have done versus what the market did. And if the market isn't sort of matching the math, then something isn't logical, something isn't making sense. And between sort of the math and the what's not making sense, we can kind of start to infer a lot of things. And also then it's a question of does it sort of invalidate our thesis or not? Because that's what the trolls are trying to do to you. And even people who used to claim to be apes are just all over this notion of, well, the reason the stock is down is because of dilution. Let's kind of just debunk that a little bit today. First of all, I told you I'm going to tell you a little bit about the time value of money. Many of you have heard that I worked at a very large company, a Dow Jones company. And at one point even, I was leading strategic projects where I'm presenting to the CFO of the company. And when you would present to kind of ask for investment money, every company has something kind of called a cost of capital. So that's this sort of top bullet on the right here. Companies use a cost of capital. We used to use 12%, so that's why I've kind of picked that number here. Different companies will have different amounts and probably even changes as the overall macroeconomy shifts. But 12% is kind of a nice number that a lot of companies might use. Some will use a higher number, some will use lower. And what that is, it's kind of like a threshold or a hurdle. Basically, if you can't beat that rate of return, then a project won't even get green lighted. And so what you often do is you look out like 10 years or 20 years. And so I'm going to show you an example here. And what you do is you just discount future cash flows. So it's this idea of every year, and it's kind of a compounding discounting. So you go like, all right, actually, let me even just back up and make this really easy to understand for all of us. If I said to you, hey, I'm going to give you enough money to buy a loaf of bread today, you'd be like, okay, cool, I'm going to go buy a loaf of bread. But if I said, okay, I'm going to give you that same amount of money and you're going to buy a loaf of bread in a year from now, you might say, well, hey, hang on, that loaf of bread's going to cost more in a year, so this money doesn't go all the way. It doesn't buy me that loaf of bread in a year. That's just inflation, right? You guys understand that easy. This is the same idea. $1 a year from now is not the same as $1 today. And $1 20 years from now is very much not the same as $1 today. So that's what business leaders are doing. They're just saying, okay, I'm going to invest this money. It's going to bring in future cash, but because it's in the future, I need to discount it. I got to bring it back and kind of talk about it in today's dollars and decide if that's worth it to me or not. And so there's two things they're doing. They're just looking at what is the overall value in today's dollars of some decision I'm making. And then they're also saying, is that enough? Is it passing this sort of like strategic threshold I have at my company, like a guideline? So that's all I'm talking about. It's not really that complicated. And someday maybe I'll kind of show you how that math works. But and by the way, if you just have Excel, there's kind of like standard formulas in there that'll just do it for you too. Okay, but in this example, I'm saying, what if you were to invest like $1 million? You were to invest in a project that would bring back $1 million a year. And you used some 12% cost of capital and you looked out 20 years. You said, all right, what's today's value of the next 20 years of this $1 million a year I'm going to get back? And so you can see like already a year from now, so this year plus one, it's not worth $1 million anymore because I apply this 12% discount to it. it's only worth 880,000. And so then if you you'll just see every year you just keep rolling that out and applying the discount farther and farther and farther. And so that money becomes less and less. So you can see, I'm getting $1 million in year 20, but it's only worth $78,000 in today's money. And so then if you add all those up, you can see in this example, you're getting $6.75 million in today's money, today's dollar. So what I'm effectively telling you is, in this case, if you were to use this 12% and you said I'm getting $1 million back a year from some decision I'm making as a business leader, then really that's worth not quite $7 million. So the next 20 years of cash flows is worth not quite $7 million in today's rate. So now that you kind of have just a quick breeze by of the time value of money or the net present value of money, and how business leaders look at it, that I'm going to use that to show what should have happened with this dilution in our debt payment. There's one more bit of, housekeeping let's cover. So the sources I'm giving you, and this is all feeding into the numbers I'm about to show you, so that you can go fact check me, so that we don't have, trust me bro kind of stuff. I am using 4 quick sources here. So you can see the bottom 3 are all 8Ks you can go find. That AMC filed 8Ks that showed how many shares were sold, how much debt was paid off, how much interest was paid, what's the price per share, all of that information was filed. So you could see, like, here's an example. This was the 4.76 basically million shares that paid off $36 million of debt, plus another $500,000 of interest, and for $7.67 a share. So you're going to see me show all of these, but I'm just showing you that I'm taking them straight from the filings. This top one, and you could even see it's kind of a different color, that's because that's from the press release. So you could see that on AMC's investor relations site. So the 3 8Ks you can go find, the press release you can go find, you can fact check me on all that I'm sharing with you, okay? Okay, so now we're just going to kind of go through the facts. And like I said, we're going to really just stick to the facts here. This is not even math, this is just the filings. And so you're going to kind of get a little bit of illumination first on what happened, what the transactions actually were, what kind of value they should have added to the company. Then we'll go through that math and kind of back it up. And so you'll even get a sense too of what large money, institutions, debtors are sort of paying here to get a hold of some of these shares. So the first one from that press release, you would go see that there were 48 million shares sold. Those actually raised $350 million of cash, but let me kind of show you why I'm calling this effectively 310, or this 309.84. Because what happened is they raised the 350, but they went out and paid $50 million of debt down. Now we need to count both of these, right? Because having cash in your company, there's value to the cash. That value should be reflected in your stock. So that's one. Then they paid down this debt. And you might say, well, hey, retail, how come it doesn't say then $300 million of cash? Isn't 350 minus 50, 300? Yes, it would be. But you then go back and remember on that press release, they got a discount. They paid off that debt at about a 20% discount. It was 19.67%. So if you apply that discount, then it only cost roughly 40 million. It's just over 40 million bucks that it actually cost. So that means then the cash that they're left with after paying down $50 million of debt is that 309.84. So we're going to need to count all of this as we think through what's the value that should have been reflected in your stock. Okay, as they paid off that $50 million of principal, but remember only spent about 40 to do it. So that difference, the 10 million, is also really value that should have been reflected in your stock. Anyway, the interest paid, so they also paid off about $500,000 of interest that was owed. And so effectively, what you get to is the principal plus the interest amounted to $7.51 a share. So there was a debtor who kind of said, all right, at a price of $7.51 a share, we'll let you pay off this $50.5 million effectively. The $50 million of principal and the $500,000 of interest. And then remember, keep in mind, because this is going to matter here in a minute, that's actually, it's not just we paid off $50 million today, we're also saving $5 million a year on interest in the future. So there's today's action, but also there's a future value that we need to kind of assign to the stock of there's $5 million a year of interest that AMC no longer has to pay. So there's $1.25 million every quarter that you're going to see in the bottom line in the earnings, because any dollar saved on interest goes straight to the bottom line outside of taxes. But it's bottom line savings. It's just cash that no longer goes out the door. Okay, then on December 12th, there was another, let's call that $1.5 million. Didn't raise any cash there. That was just debt payments. All the rest of these three are going to be paying off debt. So there was another $12.25 million of debt paid off, another $500,000 of interest paid, and then an effective share price on that one was over $8. So whoever that was who said, yeah, sure, you can have my debt, they sold their debt at $8 a share, $8.20 a share almost. And then remember, we're going to save that interest every year now. That's $1.25 million of interest we no longer are going to have to pay. Okay. By the way, the reason I'm saying that, so these are on if you looked at the details, they're on some debt that's due in 2026. All of these were on the same, what I call tranche of debt, the same bucket of debt. And it's a payment in kind, second lien that is kind of a 10-12% toggle. And so I'm just using the lowest amount there, this 10%. So we might even be saving more interest than what I'm showing you, but I'm just making myself troll-proof, FUD-proof. I'll just go ahead and be conservative and use the 10% interest rate. So that's what you're seeing here. Okay, then we had a third round on the 15th, 4.75 million shares. That's the one that paid off the $36 million bucks and a little bit of interest, not much, about $30,000. It was like actually $27,000 at a price of $7.67 per share. Okay, so you're hearing all of these just happened, and institutions were giving AMC basically far more per share than what the market has priced it now, right? So that should continue to tell you something. That's going to save us $3.6 million a year on interest. All of these are starting to add up. Just think of kind of a whole Dave Ramsey type of concept. I'm not suggesting whether I support or don't support him. I'm just saying the idea of snowballing. You pay off high interest debt, you start to save that money, and that money you've saved you can use to pay off more debt, and you quickly you start accelerating the rate at which you're paying debt off. And I see Adam starting to do that. All right, shares sold. So then we had another 3.35 that paid off $25 million bucks. And I'm using some math here. So that's the first asterisk we got to get at. So at the bottom here, I didn't see on that one, they didn't show any amount of interest paid. So I just used kind of the lowest rate from the other transactions of how much interest was paid versus how much principal was paid. So I'm calling that another $700,000 saved. But we could even wipe that out if we had to. It's so minimal, it's not going to change our math really much at all. Anyway, so I come to an effective share price of $7.47. Again, perhaps that'd be a little bit lower if you said there was no interest paid. And then you get this yearly interest saved of $250. Okay, so the total. So we've had 58 million shares. We got to acknowledge that. That's real. I continue to, on Twitter and here on this channel, say I'm going to acknowledge the facts of what's happening to our stock. But even in that, if I'm being real and I'm not laying down hopium and neither am I laying down despair, and even in that real place, I can be as bullish as I am, then that thesis continues to hold. I believe in this stock. I do. Okay, we raised that $300+ million of cash that we still held on to. We paid down $123+ million of debt. Don't sleep on that. That's a big deal. In a few days, we wiped out $123 million of debt. We wiped out almost $2 million of interest we owed. So that's gone now. The effective share price, if you do a weighted average of all of these, just look up what weighted average is if you don't know what that is. The weighted average share price was $7.54. And remember now we got to turn our eyes to the future and to the actual value of this stock today based on future earnings. All right, so we have this $12.33 million a year that we no longer have to pay in interest. That's going to be added to earnings, right? So every quarter, divide that by 4, we got our kind of $3+ million you would add to earnings. All right, so about that dilution, let's talk about this. So it was announced at basically right after Q3 earnings, or kind of right on the heels of that. So we had our best ever earnings yet, and we had 198 million shares at that time. So file that away. That's going to matter. We're going to go through the math using that sort of as a starting point. Since then, we've had 29% dilution. All right. So remember, we had this 198 million shares. We added the basically 58 million shares. It's 29% dilution. The stock price is down 41%. I'm showing 6 here, actually, sorry. In the rest of the math, I'm going to use 607. I'm going to actually use our close today. I just hadn't updated that bullet, but close enough, right? So I think it's maybe more like 39% or something, but use 607. So all right, we're down about 40%, but the dilution was only 29%. And that's not even talking about the value creation yet, right? So this is why the sort of dilution fudsters, you can just kind of tell them to take a hike because none of the math is going to add up. So everything that they're saying shows that they either don't understand markets or they're just trying to manipulate you. And either way, that's someone I don't need to listen to. All right, so here's the key. Don't sleep on this bottom bullet. The market cap, remember that size of the pie? The market cap is actually down. So when people just yell at you about dilution, they're not acknowledging what is the reason this company as a whole, the whole company, is actually worth less now since awesome earnings have been announced, candy has rolled out, Amazon and Kroger have rolled out with popcorn. That's thousands of doors equivalent. And the strike has ended, right? So like there's nothing that says the company itself, forget how many shares there are in dilution and all of that. Just make things simple. There's this saying like make the crooked path straight. Think straight. Don't get all twisted. Is this company worth less than it was like a month ago? And if so, why? What reason would the company be worth less? We've paid off debt. We're going to have stronger earnings, a stronger balance sheet. We've rolled out candy. We've rolled out popcorn to Amazon and Kroger. The strike has ended. That's a lot of reasons for the company to actually be worth more, not less. Set aside dilution for a minute. Just think about the total size of the pie. Should this pie have shrunk? Because that's what's happened. The pie actually shrunk. People are trying to tell you that's dilution. That's not dilution. That's people, that's the market saying the value of the company is less. And I would suggest that's not a real market dynamic. That is price manipulation causing that. All right, but let's go through math. Let's not make it emotional. Let's not make it opinion based. Let's just math it. So when we had earnings, we were at 1009. Okay, so I'm going to go from there. Since then, dilution got announced. That 48 million that was sold to get us the cash and the first payment and all of that, that was happening in multiple days. And so we're just going to have to start from when that was announced. So I mentioned there is 29% dilution. So in theory, if you added no value to the company, then your stock should have gone down by $2.90. But we're not down by that, are we? We're down by $4. So how do you explain the rest of that, right? That's that manipulation and fraud, in my opinion. Okay, so that's just dilution. But now, remember, we generated something from the dilution. The dilution, it's not the end action. It does something. So what did it do? Well, it brought in that $309 million of cash, and it paid off that $123 million of debt, which saves us the 12 plus million a year. So what if we said, remember I said, hey, what about that cost of capital? I gave you that example. So what if we looked at that $12 million of interest savings that you have every year? Now you might say, hey, wait a sec, that debt was due in 2026. But what I'm saying is, I think the market would have said, hey, we're not sure they're going to pay that off. Perhaps they're going to refinance that and have to roll that out. And so I think it's fair to still count out years, future years, and say that interest is no longer going to hit the company's books. And so it's going to be now added to the bottom line, sort of in perpetuity, let's call it. So I'm just going to look at a 20-year horizon. And if we just said, because I've told you in other videos, about this idea of price to earnings, which we're also going to look at in a minute, and being somewhere between 20 and 25 in our industry. So I just said, all right, let's just have a nice round number and look out 20 years. So we use that 12% cost of capital. So I just explained to you a little bit ago, we're going to discount future cash flows. So that 12 million we're saving every year in interest that's getting added to earnings, we're going to go ahead and say, well, it's not worth as much year by year by year. It's becoming worth less and less and less. So what's the value today that should have been added into our stock price is what we're really getting at, of this cash that we generated and of all the savings we're going to have on all the interest. Well, that should have added $1.50 back into the stock, which means after all of this, even with dilution, we should have been at something like 870. So I'd actually say these debtors are getting a little bit of a discount. But, it always depends on, what your starting point is. I started from a very high stock price there. Not a very high, frankly, it's low historically. but I started from a high point that we've been at lately, but we were there going into earnings, and the earnings delivered. We beat all of Wall Street's expectations. We had our best earnings ever. We beat pre-COVID levels on half the movies. Like, there's just nothing but bullishness in this company's results. So as long as the stock is divergent from the business fundamentals, boy, I see value in this play. And that's why I'm here. Both value and the squeeze. I think we have a value play on top of a squeeze play. And that is why I'm so bullish. So anyway, if you said, all right, even I want to factor in the dilution, that should have brought this stock price down. But now we got to add back in, okay, but we brought in cash and we saved on future interest. So that should land us at about $8.70 a share. If we used, I showed you in another video that really, especially with any kind of growth, it'd be reasonable to have like a 24-year price to earnings on this stock once we start having positive earnings. If you were to use, instead of 20 years of this discounted cash flow that I just showed you, if you looked at like 24 years of price to earnings priced into the stock, then we should have landed at 952. So that all I'm saying is either one of these methods adds some value back into the company. Value creation. I'm going to keep hammering that home until the trolls can't FUD you anymore about dilution. Dilution also creates value. Now you see, I'm being real. That means the stock would be down. But if I was also being real on any other stock that's not manipulated, a non-manipulated stock, I would say there's a lot of value in terms of a cleaner balance sheet, debt paid off, a stronger company that's been showing moves towards growth, right? Like, I'm not showing you even what's the value of the fact that we just expanded popcorn. What's the value of the fact that we just added candy? What's the value of the fact the strike ended? Now, I go through all that in another video. I think it's a couple of videos ago where I kind of say, hey, what's the value of this company? Covered that a little bit. Go there if you want to see both a price to sales and a price to earnings look. I do a whole walkthrough on that. But so I'm honestly kind of almost throwing trolls a bone here, throwing shills a bone, in that I'm doing this far more conservatively than I ought to. So frankly, I don't think our stock should be down at all, but I'm just showing you, even if you want to use just straight up math on only the stock transactions and not kind of thinking about the future value of cash flows from candy and the expansion of popcorn and all that, which we should price in. But even without those, you land at this, either 870 or 950, whichever method you want to use. And then let's not forget, we did pay off debt. If you wanted to add that back in, that's 48 cents a share, just sort of the total value of that debt divided by all the shares. Okay, so the takeaway point is, no matter how you look at it, if you look at a price to earnings view, if you look at sort of the discounted net current value of future cash flows, however you look at this, the fact that our stock is down about $4, even straight up dilution should have made it only be down $3. And adding back in the value means it should only be down like $1 or $2 at the most, $1 or $1.50. There is nothing at all logical about the fact that we're down. And again, just come back to market cap. That's how you get to this, basically this negative 294. Like, for the market cap to not have shifted at all, then we need to have not gone down as much as we have. So you just ask yourself, if all these things have been rolled out and we just delivered, better than 2019 results on half the movies, you say that out loud and it doesn't make sense that we're now worth less than we were, right? So that's just painfully obvious. So I just wanted to show you that and continue to reaffirm, if you go through the forecast video I did on Q4 of this year and then all of next year, and I kind of talk through a little bit about future years, you'll hear me talk about we are going to have a strike blip. Like, that's real. But what's coming is massive gains in profitability for this company. I don't think it's more than a year from now. I think it's, go there and you'll see why I think Q4 next year is phenomenal and why we'll be growing along the way. But there's real strike impacts. That happened. That's real. And we're living through that now. Like, we were supposed to have Dune. We were supposed to have Ghostbusters. We were supposed to have Craven. Those were all supposed to be in this current quarter. And we would have been rocking and rolling with a few of those movies added back in. And so it's okay. But the thing is, generally investing is a patient game, and it's a game for the future. And if you're willing to be patient, like what did Warren Buffett say, right? Like the stock market, what did he say? It's like a device for transferring money from the impatient to the patient. I'm going to be patient. And at some point, I honestly believe we're going to break the shorts because this company is going to be delivering the results. It's painfully clear to me. And so I'm here. I'm not going. And like I said, I think it's a value play on top of a squeeze play. All right. Finally, I said I would get away from the math and kind of share a few other things. Just real quick, a little bit of a tease on some things I see out there. I've said to be tracking these Bitcoin spot ETFs. It's been real interesting to see that they are becoming kind of a cash only settlement, not payment in kind, or so there's going to be kind of not the option for folks to manipulate as much. They're going to have to come up with the cash. So actually, let's look at the right here. It's something I spelled out today on Twitter. There's a lot more to it, but I was just kind of giving a few sort of, I don't know, breadcrumb items. If you think about, first of all, I reposted that there are whole countries that are starting to say, hey, we're going to grant people citizenship if they're like large Bitcoin investors. That actually is the third point over there. The first point actually was more about there's whole countries that are starting to talk about Bitcoin being a currency itself, or you even kind of think about it more as a backing to currency. Like how gold, would have backed the US dollar at one point. Interesting to think about what would it look like if Bitcoin was backing currencies. And then, like I said, on point 3 there, nations basically saying, hey, if you own a lot of Bitcoin, we might want to make you a citizen. That should be signaling something to you. So those are kind of the sovereign nations. Point 1 and 3 is where sovereign nations are going. That tells you a little something. Now, I've mentioned halving before, so if you've been following any of my videos, I dropped that one, I don't know, a month ago or something, that halving is coming. Think of that like what would happen overnight to gold if suddenly it was twice as hard to mine gold, twice as hard to get it out of the earth. It would drive the value of it up a lot. If it's really, really hard to get something, it becomes pretty precious pretty quick. So that's a drop in supply is how you can kind of think about that. It's not really a drop in supply, it's a drop in future supply. It makes it harder to get, makes it take longer to get. So that generally would push a price up. The ETFs is basically a demand increase. So if at the same time it's harder to get supply and demand is going up, that's pretty interesting, right? And by the way, for me, all of this relates to AMC, and we'll do that kind of in a future video. I said in a tweet, I kind of laid out a little bit of a thesis almost on why I believe that the SPY being at all-time highs is for me, it's not that bullish. I'll put it that way. People say buy low, sell high. They don't say buy at the top. Now, if you believe it's going to keep running, you believe I'm wrong, then fine. Maybe we're into some new bullish cycle. I laid out a lot of reasons why I don't think we're into a bullish cycle and why I'm concerned that the SPY is at all-time highs. And the Magnificent Seven, if you don't know, that's, kind of like NVIDIA and Meta and a few other companies like that. So you can just Google what that is. Anyway, basically stocks at all-time highs. While I think there's a lot of reasons they kind of maybe shouldn't be, and then come back to this notion of this cash settlement in the Bitcoin spot ETFs. So if you got to bring cash, where are these guys getting cash from? So I just want you to kind of think about those 5 points and what all that might mean. Yeah, and then the bonus point, I don't think Sam and CZ should have messed with tokens. By the way, that's what the thing on the left is about. And the thing on the left is also about some future events that are coming. I don't think the big guys should have used so much wrapping paper. I'll leave that one vague and mysterious for now. I'll try to explain that in the future. This thing on the left is just, it's symbolic, and I'll let you kind of just play around in your mind with what I might mean. But basically, there's this Egyptian mythology, not methodology. There's this Egyptian mythology that effectively there's this kind of god of the underworld who weighed your heart. And if it weighed more than a feather, then basically your soul was destroyed. And so there's a chance that Bitcoin in the future is going to act as a bit of a scale to measure assets. And if they're found rotten, perhaps they're going to be destroyed. That's going to get real interesting, and that's going to relate to AMC as well. All right, but setting all that aside, look, I keep saying the fundamentals are not in line with the value of the stock price. I truly, truly believe the logic, the math, the future, look, I've tried to highlight quite a few times how often my forecasts have been right. There's a reason for that. It's what I'm saying is I have a high degree of confidence at this point about where we're going and about what's next. It doesn't mean I'm right. You can't invest based on what I say. I'm a dude on the internet sharing opinions with you, but I have a track record of being right. I'm hoping that I'm going to continue to be right. And let me put it this way: I like the stock. Let's go.